Are we having fun this week? The market is offering up some great sales for those savvy enough to take them. The scared money is selling. The smart money, though, is buying. And will continue to buy on the way down for however long we might be from this bottom. Some seriously good businesses are going on sale. But while sales are popping up all over the place, there are some businesses we want to avoid. No matter how low they go, these 5 stocks are the ones to shun from your portfolio. Welcome to The Quality Investor. I am discussing 5 businesses in this video that are at or near their 52-week lows. But instead of offering good value, I believe these businesses are about to go even lower. One aspect of stock picking I was lucky enough to learn early on is that a stock at its 52-week high may still offer excellent upside, meaning even at a high, its intrinsic value as a business is still significantly lower than what the market is pricing it at. The flip side, of course, is that even if a stock is at its 52-week low, it might still be significantly overvalued or trading much higher than the intrinsic value of the underlying business. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Once I realized this, I lost some of the fears I had around buying businesses at what seemed like ultra high prices. One example is Visa. When I first started buying Visa, it was at all-time highs at the time, trading in the high 230s. Likewise, Costco was at all-time highs when I first started buying it at $606 a share. However, the same cannot be said for a loser buy that I made. Pfizer was at a 52-week low when I first bought it, around $39 a share. The stock kept dropping, and I finally cut my losses at $27. It now sits at $23.24. This is probably the single biggest mistake I've made in this game, but I learned some valuable lessons. Stocks trading seemingly cheap might be cheap for a reason. Pfizer, for example, had really bet on COVID vaccine demand remaining steady. That failed to happen, and the projected sales never materialized. They also had a few drugs in their pipeline either not be approved by the FDA or they stopped their progress after trials. The market reacted negatively to the lost potential revenue. The lesson here is that I failed to understand the business. That is one reason why 52-week lows can be a mirage. If you don't understand how the underlying business operates, you could be in for some losses. Another is business fundamentals. Have revenues been declining quarter after quarter and year after year? What about margins? Have they been contracting? Contracting margins is a sign of eroding competitive edge. Is ROIC declining? If so, perhaps management has been making poor choices for capital allocation. Maybe they are chasing acquisitions to jumpstart revenue growth. That's what Pfizer attempted. Each business we're going to discuss has been affected in some way by the aforementioned reasons. These are all signs that further declines are on the way. Now, it is possible this will be a temporary situation for these companies. That is the nature of business, especially in an environment as competitive as the United States. But while turnaround is possible, I personally avoid turnaround plays. Just too much uncertainty for me. So, without further ado, let's take a look at what we are dealing with today. This is the list that we are going to look at today. We have Pepsi, Nike, United Parcel Service or UPS, Target, and Best Buy. You can see all of them are at or near their 52-week lows, within 10% at least. Pepsi trading at $146.61, a 52-week low of $141.51. Nike at $57.25 with a 52-week low of $52.50. UPS, $97.71 with a 52-week low of $96.57. Target at $95.72 with a 52-week low of $90.62. And Best Buy at $60.44 with a 52-week low of $57.34. And with the exception of Pepsi, each one of these have suffered mightily year to date, all down over 20%. And you can see on a 10-year basis, and these are annualized returns, they're essentially flat over the last 10 years. Meaning if you had put your money into any one of these stocks, you would have lost out to inflation. So each of these 5 businesses are struggling, but how badly are they struggling? Looking at the business's most fundamental metrics and their 5-year compound annual growth rates, we can see none of them are faring too well. The median revenue growth for these 5 businesses is 5.6%. None of them have achieved over 10% revenue growth over the past 5 years. And even worse, when we look at the gross margin and the operating margin, all of them have seen declining margins over the last 5 years, with the exception of Nike's 5-year operating margin, where it's essentially been flat. Earnings per share is not much better, a median earning per share of 5.97%. These businesses are not growing. They're not growing their top line, they're not growing their bottom line, and even worse, they're not growing their free cash flow. The median free cash flow growth of 6.27%, these businesses are at best stagnating. The free cash flow margin itself is also declining on a median basis. There are 2 bright spots with these businesses. One, they are buying back shares, which rewards the shareholders. It hasn't really helped their per share metrics very much, however. And the other is dividend. Each of them have actually grown their dividends, at least in the last 5 years, on a pretty healthy basis. However, if we look at the 1-year dividend growth, we can see that's fallen off quite a bit. All of them have come down below 10% annual dividend growth in the last 1 year and has a median dividend growth of 2.17%. That means they're growing their dividend less than inflation. And you can see the rest of the metrics don't look very good either. The revenue growth, even less. Margins have expanded a bit, but they're also losing on earnings per share. So these businesses have clearly at best stagnated, or at worst, they're declining. And an important note about the dividends is when that dividend growth is slowing, that means the businesses are not earning as much free cash in order to distribute to shareholders. Let's start with Pepsi. You can see Pepsi's income, their top line here, has very much stagnated over the last 10 years. And you can see on all of their important metrics, revenue, gross profit, operating income, and earnings per share, none of it has grown over 10% annually in any 1, 3, 5, or 10-year period. And I think Pepsi's stagnation is best encapsulated in the cash flow chart right here in the middle. You can see the flat line of free cash flow over the last 10 years. This is a business that is not compounding their free cash flow. This is the mark of stagnation, a stalwart, as Peter Lynch would say. And you can see that's also evident in the dividend. Very consistent dividend growth at about 7.5% per year. And that's all that Pepsi is. It's a business that's not growing. It's simply maintaining. And the picture looks a little bit worse when we look at Pepsi's profitability. Gross margin and operating margin trending in the wrong direction, heading downwards. Free cash flow margin also heading in the wrong direction. This could signal loss of market share, other competitors entering the market. And on that note, Pepsi has entered into an agreement to purchase competitor prebiotic soda brand Poppi, a deal announced earlier this month. So Pepsi's trying to buy out their competition. And we can see also very flat return on invested capital over the last 10 years or so. Nothing about Pepsi's business is growing right now. And we know that we're facing headwinds in the snack and beverage market with designer pharmaceuticals such as Ozempic really curtailing people's appetite for these types of snacks. And honestly, the only upside I really see for Pepsi is they have a strong dividend yield. Now, this is a business I don't believe is going anywhere anytime soon. But if you're more interested in dividend income and you have zero interest in growth of your capital, then Pepsi could be a good dividend play. But besides that, Pepsi is a business to avoid. Next, we're looking at Nike. Nike, once hailed as a great American success story, has certainly fallen on some hard times in the last couple of years. Revenue has been falling over the last couple years, and even worse, their free cash flow, it's trending in the wrong direction. You can see here in the earnings per share and in the fiscal year 2020 cash flow numbers, the pandemic hit them pretty hard. A lot of their business is retail based, but Nike's been plagued by other problems that I've documented in prior videos about Nike. Their most pressing issue is theft at many of their flagship stores. In fact, Nike has been forced to close a few of their flagship stores due to the lack of enforcement of theft laws by local authorities. Nike has also seen declining margins, trending in the wrong direction. Their gross margin now at 43% and their operating margin now at only 10%. 10 years ago, they had an operating margin of over 13%. Their free cash flow margin also down on a trailing 12 basis, at the very least at 7.5%. In the last 3 years or so, the return on invested capital and the return on the assets has also trended in the wrong direction. It looks like a lot of decisions management has been making for Nike have not been turning out well. Nike has also been facing very stiff competition. Lululemon has been a strong entrant into the premium athletic apparel market, and shoe brands such as Hoka have really taken market share away from Nike. Until Nike can find its position in the market again and turn around these weak financial fundamentals, this is a business to avoid. UPS has been facing many challenges over the last few years. Aside from the paltry revenue growth over the last 10 years at under 5%, their gross profit, operating income, and earnings per share are all growing less than 10% per year on a 10-year basis and even declining on a 3-year basis, earnings per share by 22.8% annually. And you can see that's really affected the free cash flow UPS has brought in, which has been steadily declining since 2021. UPS faces a multitude of issues. There's one key difference between UPS and its competitors, namely FedEx, but more importantly, Amazon, and that is UPS has a unionized workforce. Roughly 60% of UPS's workforce is unionized, whereas FedEx and Amazon both do not operate with a union. This puts a heavy burden on UPS labor costs. Aside from that, Amazon was once a staunch customer of UPS, but Amazon has built out its own delivery logistics in the last few years and is actually the largest package delivery service operating now. And loss of business to its competitors has definitely hurt UPS's margins. The margins are all on a downward trend in the last 10 years. Gross margin average on a 10-year basis at 20.8%, but just last year, UPS only did 17.9%. Same is true with operating margin, 11.2% on a 10-year basis, but only a 9.3% operating margin just last year. Their ROIC and ROCE also on a downward trend. None of these fundamentals look positive for UPS. Cutthroat competition from FedEx and now Amazon, UPS's future is looking a little bit bleaker. The company has said they are focusing on higher margin package deliveries such as B2B and express shipping, but it remains to be seen how well they can shift to that strategy. And with a 6.7% dividend yield, UPS is appearing like a yield trap. This is definitely a business to avoid. Target is next on our list here, a business characterized by stagnation at all levels: revenue, gross profit, operating income, and earnings per share. And worse yet, their free cash flow is certainly not compounding and in fact on a downward trend since 2021. Target was once the higher end version of a Walmart, offering home goods and essentials. However, Target is now losing ground to Walmart because Walmart offers a lower price on the essentials, as well as losing ground to Amazon, which dominates e-commerce. Target is being squeezed from both ends. Target is also signaling softness in the discretionary categories like apparel and home goods, which account for over 50% of Target's business and are higher margin goods. They say that consumers are prioritizing essentials amid economic uncertainty. And with tariffs now being imposed on many of the countries that Target imports goods from, those costs will almost certainly be passed on to the consumer. And Target has been no stranger to controversy over the last couple of years, being the subject of political boycotts from both sides of the aisle. And we see Target's problems manifesting themselves in the margins. We can see the downward trend in both the gross margin and the operating margin. And in a business like retail, every basis point of margin matters. And things don't look much better on the return on invested capital. We can see that has been steadily declining since 2021. And to be honest, I don't see the future getting much brighter for Target, as Amazon is dominating the internet space. We can see if Target can catch up there, but they're also being squeezed by Walmart, a vastly more resourceful business than Target. So until Target can prove that it can turn this ship around, Target is a business to avoid. Lastly, we have Best Buy. Best Buy has done nothing to inspire investor confidence over the last few years. Complete stagnation in the top line growth and declining earnings growth, as well as declining free cash flow. It's so bad that even robust share buyback programs over the last 10 years have not done anything to help its per share numbers. Best Buy is another casualty of Amazon. The consumer electronic giant faces very stiff competition from online retailers that offer vastly more selection and better prices. And another large part of Best Buy's business was entertainment. And with much of the content available these days online only, that has also hurt Best Buy's bottom line. I remember when I was a kid, I used to love going to Best Buy and perusing the vast rows of CDs, DVDs, and video games. But that is no more at Best Buy now that content has shifted online. The margins tell an even bleaker story for Best Buy. Downward trends in every important metric. This is a business suffering from its legacy brick and mortar retail presence. It is struggling to compete with the e-commerce segment since Best Buy still relies on its physical stores for revenue. And these stores, of course, incur high fixed costs such as rent, staffing, utilities, and more. But consumer preferences have shifted to online shopping. It is a bleak future ahead for Best Buy, and this is certainly a business to avoid. That is the list of 5 businesses at 52-week lows to avoid. Pepsi, Best Buy, UPS, Nike, and Target. Not a lot of upside in the future for each of these businesses. Many have internal struggles that they're trying to work out. All will have to prove it over many quarters before even considering as an investment again. So don't fall for these dividend yields, seemingly impressive on the surface for businesses with reputations such as these, but dividend yield traps, all of them. I believe these businesses are in for even more trouble down the road as fierce competition erodes these businesses' market shares and consumer spending habits change in the ever-shifting landscape of the economy. I don't see much evidence of these businesses adapting. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.